Hi students, and welcome to Accounting 2120. In today's lecture, we'll be going over Chapter 10, which is titled Individuals, Income, Deductions, and Credits. So this chapter is going to focus on the taxable income for individual taxpayers. So recall that taxable income is the base on which the tax liability is calculated. And in the simplest terms, taxable income is determined by calculating gross income, then reducing the amount by allowable tax deductions. So prior chapters discuss these terms in a general sense, and this chapter explains the rules that apply specifically to individual taxpayers. And that's with respect to both income and deduction amounts. So this chapter discusses individual tax credits that may further reduce the detailed individual tax liability. So let's go ahead and get started. So the first thing we're going to do, gross income is, again, we kind of discussed this in chapter 4. So what is gross income? It's the services. And tax law provides for the exclusion of certain types of income. What does that mean? Exclusion. So therefore, it will be excluded from your gross income. But there are some types of incomes that are inclusion. Let's look at a few types of income and whether or not they're inclusion or exclusion. So interest, insurance paid on the death of the insured is also excluded. But interest on loans, those are included, is included. And then income included per the tax benefit rule. So there are many exclusions available only to individuals, and there are fringe benefits received by employees. And additional inclusions and exclusions we'll discuss further on in this chapter. And separate maintenance payments, prizes and awards, unemployment compensation, and the determination of gross income. And they've yielded results that Congress found unacceptable. This Congress has provided more resources. So these provisions applicable to individuals are typically. Let's talk about alimony. And married couple divorces are legally separate. State law generally requires the division of property accumulated during marriage. So, of course, one spouse code distinguishes between the support payments and the property division in terms of tax consequences. So, alimony made under are neither taxable to the recipient nor deductible to it by the taxpayer. Okay, this took effect to any divorce that took place after 2002 or on entered on or before December 31st, 2018. Or on or before. So anything before December 31st, 2018. So on 31st, and they are also deductible by the party making the payments. So if you were divorced as of January 1st, 2019, then the law changed. And on top of being an exclusion is also not a deduction. It shifted from the income earner to the income beneficiary who has the legal right to the income and is better able to quickly. Pete and Tina divorced in 2018. Tina is required to pay Pete $15,000 of alimony per year. Tina earns $61,000 a year. Pete has an ultimate legal right to the $15,000 and is better able to than Tina to pay the taxes on it. As while Tina is required to include the $61,000 in her gross income, she is also then allowed to pay deduction. If the divorce had been finalized in 2019, Pete would not be required to include the alimony paid. We also have things called property settlements. Like I said before, in a divorce, these are separate from the alimony. A transfer of property other than cash to a former spouse will limit. The transferor is not entitled to a deduction and does not recognize gain or loss on the transfer, and the transferee does not recognize income and has the basis equal if you're divorced and one spouse error or capital gain or income reported on either side. And whatever the basis was during the transfer is transferred to the new owner. So no new basis. Okay, now requirements right from the payee divorce agreements executed before 2019. The parties may have an incentive to have payments treated as support obligation, alimony, rather than as part of between former spouses subsequent to a divorce. Congress developed the following rules. The payments made under pre-2019 agreements, okay, are classified as alimony only. If the following conditions are satisfied, the payments are in cash, meaning clearly disclosure decree does not specify the payments are not alimony. The payee and the payee are not members of the same household at the time the payments are made, and there is no liability to make the payments. Let's go on to child support. The taxpayers do not realize income from the receipt of child support payments made by their former spouse. So this result occurs because the money is received subject to duty. She is not allowed to deduct the child support payments because the payments are made to satisfy the payer's legal obligation to support the child. It's pretty cut and caveat to that. These rules are applied even though the divorce agreement specifies other amounts to determine whether payments subject to the pre-19 agreements are intended to be alimony or child support. This issue is often resolved by applying the following rule. If the amount of the payments would be reduced to cover the occurrence of a continuance related to a child support. All right, so prizes and awards, okay? So they publisher, clearinghouse, door prize, awards from an employer to an employee in recognition of performance. These are all taxable to the recipient. All right, there is a narrow exception permits a prize or an award to be excluded from gifts, not just one, but all. The prize or award is received in recognition of religious, charitable, scientific, educational, artistic, literary, or civic achievements, or faculty teaching award. The recipient was selected without taking any action to enter the contest. In other words, you didn't enter a contest. So you were automatically, you didn't enter. All right. The recipient is not required to render and the recipient transfers the prize or award to a qualified government unit or nonprofit organization. Okay, so unemployment compensation is sponsored and operated by the federal and state governments to provide a source of income to people who have been employed and are temporarily out of work. So in a series of limited unemployment benefits from tax, and these payments were considered social benefit from 1986 in order to reduce the unemployment compensation recipients' disincentive to work. Congress amended the code to make these benefits taxable. During the 1980s, Congress at that time felt as though that because unemployment compensation was non-taxable, and back into the workforce. So they thought making unemployment compensation taxable income, that it would give people incentive to rejoin the workforce. So if compensation, you have the option to have taxes taken out before payment, decide to make payment when comes time to file your taxes. Social Security benefits. Some is based on two factors: the taxpayer's ability to pay, and the amount of benefits considered to be a recovery of the taxpayer's taxpayer income exceeds a specified base amount, as much as 85% of Social. The taxable amount of benefits is determined through the application of one or two formulas, which is described in the code, section 86. So specific exclusions, at all inclusive definition of gross income, can be excluded from gross income only if the taxpayer can locate specific authority for such an exclusion. So let's talk about common exclusions. So gifts and inheritances. Tax 1913, Congress has allowed the recipient of a gift to exclude its value from gross income. The exclusion applies to gifts made during the life upon the death of the donor, such as bequests and inheritances. However, the recipient of a gift of income-producing property is also the donor or the descendant's estate may be subject to a gift. Gifts are often made in a business setting. So examples: an employee receives cash from his or her employer upon retirement, or a corporation makes payments to employees. In these instances, it's unclear whether the payment was a gift or represents compensation. Have defined a gift as a voluntary transfer of property by one to another without adequate consideration or compensation. So if the payment is intended to without legal or moral obligation to qualify as a gift, the payment must be made out of affection, respect, charity, or the like. So the cases about the issue have been decided on the basis of the donor's intent. Amounts received as a result of a gift. Crowdfunding involves raising funds, often a small amount from a large group of people, for artistic or technological undertakings. The broad definition of gross income provided in the tax law: crowdfunded amounts received are given without an expectation of receiving anything in return. Then such amounts may meet the criteria to be considered a gift, and therefore would be excluded. Scholarships. Payments or benefits categorized as scholarship, compensation for services, or a gift. The scholarship rules are intended to provide exclusion treatment for education services. To be excluded from income, the scholarship must be used for tuition and related expenses such as books and supplies. Includes, we talked about this before in class, I believe. If you have a scholarship that includes money for housing, is considered taxable income. Uh, Athletic scholarships are generally excluded from income because they are granted to assist students in paying for their education. Also allows athletic scholarships to be included to include a cost of attendance amount. So in addition, it can include expenses like academic related supplies, transportation, and other similar items differ from campus to campus. However, the amounts received for tuition, books, and supplies is still excluded from gross income. Damages. Okay, so a lot of times the person who suffers harm caused by another is often, so the tax consequences of the receipt of damages depend on the type of harm the taxpayers receive. The taxpayer may seek recovery for a loss of or even personal injury. All right, so reimbursement for a loss of income is taxed in the same manner as the income replaced. The recovery of an expense is deducted. The damages generally are taxable under the tax benefit rule. A payment for damaged or destroyed or exchange of the property, thus the taxpayer has a realized gain if the damages received for personal injuries received special treatment under the code. So let's talk about personal injuries. Is that the amount received is intended to make the plaintiff or the injured party whole as before the injury. And it follows that if the damages received were something less than the actual damages incurred, and the injured party would not be whole as before the injury. So with respect to personal injury damages, a distinction is made between compensatory damages and punitive are intended to compensate the taxpayer for the damages incurred. Okay. So only those compensatory damages received for physical, personal injury, or physical sickness can be, it includes amounts received for loss of income associated with physical awarded on excluded from gross income, except for the extent of the amount received for age discrimination or injury to one's reputation is also not excluded. But let's talk about punitive damages. These are amounts that to the victim as punishment for outrageous conduct. So these are not compensating, okay, for loss of something. These are kind of like a fine or a penalty placed on the person that caused punitive damages are not intended to compensate the victim, but rather to punish the party. Amounts received as punitive damage may actually place the victim in a better economic position. Therefore, the harm before the harm was experienced. Thus, punitive damage list. So we have compensatory damages. It talks about getting reimbursement for a loss of income. So if you get reimbursed for loss of income, then that portion received is taxable as though your property is treated as an amount received for the sale or exchange of the property received exceeded the property's basis. Then damages for personal injuries received. Punitive damages and punitive damages are included in gross income because they are not to compensate, but rather to punish the party who caused usually ends up in a better economic position than before the harm was experienced, unlike with compensatory damage and injury. All right, workers' comp. So state workers' compensation law requires related injuries. In other words, you are an employee, you are injured while at work and you're not able to work. These state laws are enacted to allow the employee to recover the damages without suing the employer. Although the Congress has excluded workers' comp benefits, workers' comp, then the compensation you receive is not included in your gross income. The tax treatment of these depends on the taxpayer's employer. Okay, so the taxpayer are excludable even though if the accident and health insurance protection was purchased by the individual's employer, which we will actually discuss, I believe, in chapter 11. All right. So Congress has attempted to assist the low-cost college education with some specific tax benefits. One of those benefits is an interest income exclusion on education. U.S. government savings bonds may be excluded from gross income if the bond proceeds are used to pay qualified higher education over the age of 24. So qualified higher education expenses consist of tuition and fees paid to an educational institution. If the redemption proceeds exceed the qualified higher education expenses, only a pro rata portion of the interest will qualify for exclusion. So let's look at an example on this one. Tracy's redemption proceeds, principal of $4,000 and interest of $2,000. Tracy's qualified higher education expenses are $5,000 because the redemption is only $1,667 of the interest is excludable. How did they come up with that amount? They took the total amount proceeds from the SAT bond, which was $6,000, expenses, which was $5,000, So they took her education expense and divided it by the proceeds from the bond, and then multiplied that by the interest of $2,000. And that is the amount that is excludable. If it exceeds a threshold amount, the exclusion is phased out. So modified adjusted gross income is adjusted gross income prior to the foreign earned income exclusion, and the are adjusted for inflation each year. In 2020, the phase out begins at $82,350. The phase out is complete amount by more than $15,000. The otherwise excludable interest is redeemed. Your modified adjusted gross income minus the phase out amount divided by the threshold, and multiply that by the excludable interest before phase out. And let's go ahead and look at an example. And we're going to go back to example 11, except that Tracy's modified adjusted gross income for 2020 is $86,000. Phase out results in Tracy's interest exclusion being reduced to $406. So they took the $86,000 of her modified adjusted gross income, divided it by the threshold amount of $15,000. Okay, multiplied it by the excludable interest before phase out, which became, therefore Tracy's exclusion is $1,261, which is the 1667 minus the 406. So this is how she came up with 2,000. Then she would take the 1667 minus exclusion. Now again, the phased out amount is when, if you have a joint return, you have income over of 123,550 or above, or if you're single, 82,350. Wrongful incarceration. So those amounts received as damages for being wrongfully incarcerated. So if you are put in jail or prison and found that you are wrongfully incarcerated, then usually the state pays you compensation, either federal or state. Excuse me. Excuse me. And that is considered excludable. You will not have to pay taxes on that compensation. Exclusions of gross income. Now, if you remember, we have income, broadly defined income, which is everything you bring in, whether it's money, services. Then you look at each type of income and determine if it is included or excluded from your gross income. So we just covered a lot of examples of types of income that are included and been able to determine that. Then you have your gross income. Okay, so and now we're going to talk about some deductions. All right, so taxpayers are allowed to deduct from your adjusted gross income. Okay, and these are like specific expenditures. So let's talk about some of these deductions and how they can be classified. So we have expenses that are purely production or collection of income, and the management of property held for the production of income. Okay. So right here, this exhibit is a partial list of itemized deductions. So we have a list of personal expenses that can be deducted. You have medical expenses, you have real estate taxes, you have personal property taxes, home mortgage interest expense, charitable contributions, and casualty losses incurred in a federal. Expenditures related to income producing activities would be like any kind of investment interest. So the election to itemize is appropriate when the total itemized deductions exceed the standard deduction. We've talked about this a lot of times when you are listing all of the expenses you have that are deductible. You're going to compare that total to the standard deduction. And the standard deduction is based amounts that change with inflation every year. And you compare the two and you take the greater of the two. So if your list of itemized deductions exceeds the amount of exceeds the total amount of items listed that for itemizing, then you go with the standard deduction. So you always go with the greater of the two. Expenses. So medical expenses, they're paid for the care of the taxpayer, the spouse, and dependents are not reimbursed. So medical expense deduction is limited to the amount by which the expenses exceed 7.5% of the taxpayer's adjusted gross. The term medical care includes expenses incurred for the diagnosis, cure, mitigation, treatment, or prevent any structure or function of the body. So medical expenses also include premiums paid for health care insurance, prescription medicine and insulin, and lodging while away from home. Really good examples of deductible and non-deductible medical expenses. So let's look at the deductible. We have medical care with drugs and insulin, special equipment such as wheelchairs, crutches, artificial limbs, eyeglasses, hearing aids, transportation for medical care, premiums, costs of alcohol and drug related rehabilitation, actually, and then weight reduction programs related to obesity. These are all under the list of non-deductible would be funeral, burial, or cremation, non-prescription drugs, cosmetics and toiletries, diaper services, programs for the general improvement of health, and then elective cosmetic surgeries. None of these are considered deductible. Now, let's talk about the weight reduction. Okay, so there's a specific word you have to be labeled obese, and which is considered a medical condition. So treatment for medical condition is deductible. Obese, and therefore not fall into that medical condition, does not qualify. So that's where those difference really kind of fall into when it comes to that. Again, and then the last one, unless the surgery is medically necessary. So cosmetic surgery is necessary when when the effects of a deformity arising from a birth defect or a disfiguring disease. So again, if the cosmetic surgery is related to a medical condition and is prescribed due to the medical condition, then it can be considered deductible medical expense. But if it's just you want a facelift, then it is not considered a medical condition and therefore not deductible. Now, here's the big that it does affect a lot of us. Usually as we get older in life, when it comes to the care of our parents and nursing for the aged, including meals and lodging, can be included in deductible medical expenses if the primary reason for being in the home is any costs of medical and nursing care are deductible expenses, but the cost of meals and lodging are not. Okay, so a lot of times staying home care for medical reasons such as rehabilitation after all the expenses are deductible. However, if they're there because personal reasons such as unfortunately they get to the point where they're old and not care for themselves for a reason, then only the medical costs are deductible, but the costs of meals and lodging are not considered medical expenses and therefore not deductible because they're not there for medical reason, they're there for when capital expenses used primarily by the patient, and the expense must be reasonable in order to be deductible. So examples are such expenditures include like having an elevator or any kind of wheelchair accessibility to the home, the house or home that person is living in. Those are considered capital expenses and could be considered deductible. Medical expenses for spouses and dependents. A tax is dependent on time the expenses were paid or incurred. Transportation, meals and lodging. So payments for transportation to or from appointed. The costs include bus, taxi, train, or plane fare. Charges for ambulance services and out-of-pocket expenses for the use of an automobile. All right, so those are all considered medical expenses that can be deducted. All right. So there are some statutes. So a deduction is allowed for certain state and local taxes paid or incurred by the taxpayer. It's important to understand that it's less incurred as a business expense or as an expense in the production of income. Okay. So the word taxes is defined as an enforced contribution enacted of taxing power and imposed and collected for purposes, and not as payment for a privilege granted or service. As a result, fees, regulations, hunting and fishing licenses, etc. Not all taxes are deductible. Example, federal income, they relate to personal rather than business activities. So an example is the excise tax included in the cost of purchasing gasoline. Deductions are in the next exhibit. So deductible property taxes, state and local personal property use taxes, and foreign income taxes. So interest expense is tax deductible is expense is incurred. Context in which the interest is incurred, so necessary expense. And most personal interest, such as interest paid on credit cards or car loans, is not deductible. But interest on qualified student loans, investment interest, and qualified residence interest, such as home mortgage, is deductible. All right, so let's look at a couple of examples. So we have interest on qualified student loans. Taxpayers who pay interest as a deduction for adjusted gross income. The deduction is allowable only to the extent the proceeds of the loan are used to pay qualified education expenses to a qualified education institution. Okay. The example below shows how you can calculate it. So in 2020, Kurt and Rita, who are married and file a joint return, paid $3,000 of interest on a qualified student loan. Excuse me. So their modified adjusted gross income was $147,500. Student loan interest is $2,500, but it must be reduced by $625 as a result of the phase-out rules. So they have $147,000 modified adjusted gross income. Subtract out the phase out floor of 135,000 and divide that by the phase out range of 30,000. Then you multiply that by their total amount, and this equals a $625 reduction. Then you take the maximum deduction of $2,500 and subtract it by the 625 because of the phase out rule. So the interest deduction they can report is $1,875. Now again, that is if their modified adjusted gross income exceeds the phase out floor of 135,000. Interest and investment interest. So years ago, wealthy taxpayers used the interest deduction in the tax law to create wealth by borrowing to purchase investments that would appreciate over time. The interest on the debt was claimed as an ordinary deduction, only a capital gain tax was due on depreciation. So today's interest deduction could lead to tomorrow's capital gain, interest on interest, which is interest paid on debt borrowed for the purpose of purchasing or continuing to hold investment property. Right? So the deduction for investment interest allowed during the tax year is limited to the lesser of investment interest paid or the net investment income. So example, Ethan's financial records for the year reflect the following. He had interest income from the bank savings account of $10,000, a ad valorem property tax on investment of $2,200, and his investment income amounts to $15,500, which is the top two added together. The interest income from the savings account and the annuity receipts. His net investment income is $15,300. Consequently, the investment interest deduction is limited to $15,300. The lesser of the investment expense was less than, then that would be the amount he would deduct. But since his investment income was the lesser of the two, then that's the amount he could deduct. Oh wait, okay, so we have qualified or resident interest during the taxable year of indebtedness. Qualified rest on acquisition indebtedness and interest on home equity loans. When qualified residence has to be defined. So this includes the taxpayer's principal residence and one other resident of the taxpayer or spouse. The principal residence meets their sale under section 121. So in most cases, interest paid on a home mortgage is fully deductible and there are no limitations. A deduction is allowed for interest paid or accrued during the tax year. And acquisition indebtedness refers to the amount in or improving the taxpayer's qualified residence. So let's go ahead. Let's just start looking at examples before getting into it. So Larry owns a personal residence with a fair market value mortgage of $420,000. His equity in his home is $180,000. That's the fair market value less his outstanding mortgage. Now, Larry borrows $75,000 that is secured by a second mortgage on his home to put an addition on his home. So all of Larry's interests and the total of the loans does not exceed $750,000 or the value of the home equity loan proceeds to buy a new car and boat, then the home equity loan interest would not be deductible. All right, let's talk about charitable compensation. Sections 5 through 6 of the code, section 170, allows individuals to deduct contributions made to serve social welfare needs and thus relieve the government of the cost of providing these services to the community. What is criteria for a gift? So qualified organization. Okay. The major elements needed to qualify a contribution as a gift are means you have to have a donating in return. The taxpayer has the burden of establishing that the transfer was made from the motives of generosity. There have been situations that have led to mutual benefit for a contribution. The value of the benefit is not deductible. Okay, so if you receive any kind of benefit from the contribution, it's not state or local tax credit to taxpayer to donate. So due to concerns that state and local governments might expand the availability of these programs to help taxpayers work around the $10,000 state and local tax deduction limit, the benefits is not contribution. Let's look at a couple of examples. Let's talk about the benefit received rule. So Jacob purchased a ticket at $100 for a special performance at the local symphony. The concert is normally $35. Jacob is allowed only $65 as a charitable contribution. Even if Jacob does not attend the concert, his deduction is limited to $65. However, Jacob does not fit, he can still deduct the full $100 amount. All right, let's look at Jane. In 2020, Jane is a resident of State G. She donated $5,000 to State G Scholar Program. The donation provides Jade with 60% state income tax credit. So that can be used to reduce her overall state tax, like to convert a state income tax payment into a charitable contribution. On Jade's $22,000, because the credit she received is more than 15% of the contribution made. As a result, her charitable contribution deduction for this $5,000 donation is reduced to $2,000. Non-deductible items. So in addition to the benefit received rule and restrictions placed on the contribution of services, the following items may not be deducted as charitable contributions: dues or several groups, cost of raffle, bingo, or lottery tickets. Really quickly, lottery tickets. If you do happen to win the lottery, if you kept all day that you didn't win anything, you could possibly deduct those expenses from your lottery winnings. Just FYI. But below is a continued list of non-deductible items that may not be deducted as charitable contributions. In order to claim a charitable contribution deduction, the taxpayer must have appropriate documentation. All right, so the specific type of documentation required depends on the amount of the contribution and whether. So for a single contribution of $250 or more, no charitable deduction is allowed unless the taxpayer receives written acknowledgement of the donation from the charity that notes the donation. Okay, so the taxpayer must have the required documentation before the tax return with the claimed contributions results in disallowance of charitable contribution. So other itemized deductions. So in general, no deduction is allowed for personal living or family expenses. However, a number of expenses and losses are deductible on a Schedule A 1040. Gambling. So again, we kind of talked about that lottery. So that's considered kind of a gamble. You can deduct your losses and expenses up to the amount. So even though it says gambling, most people associate gambling with casinos. Lottery can be considered gambling. So again, if you keep those lottery tickets you purchased that resulted in a loss, then the money you spent on those lottery tickets can be considered to the amount of the winnings if you do happen to win. So just FYI. Impairment related work expenses for a handicapped person, and federal estate tax on income earned or a bonus or interest income, etc. So now we're going to go into credits. Okay, so determine your total income, take out all your exclusions, have your adjusted gross income, then determine all the different types of expenses that you can deduct that under your itemized. Then you have your tax liability. Your tax liability or your taxes determine your tax liability. So you would take your tax income after all your exclusions and your deductions. You have your taxable income to your tax rate based on your filing status. And then that gives you your tax liability. Once you determine credit, so a tax credit and an income tax deduction, they're not the same thing, okay? So tax deductions reduces your base, your taxable income, okay? A credit, you take out your exclusions, you get your gross income. You take out your deductions, you get your taxable income. Your taxable income is then compared to your tax rate based on your filing status. Then you have your tax liability. All right, and that is the amount of taxes you owe. Tax liability means the amount of taxes you owe. So once you have that, then you have some credits you can apply. So it's a reduction in the amount of taxes you owe. There's so many different expenses, like your deductions. You'll have thresholds, you have percentages, etc. This is supposed to be a dollar for dollar. So the adoption expense credit assists tax to the adoption process. These are adoption fees, attorney fees, court costs, social service costs, transportation costs, etc. In 2020, up to $14,300 of the credit. Okay. So the credit is non-refundable. However, any unused adoption expenses credit may be carried forward up to 5 years. So if your expenses exceed the credit that you can for each year, you can carry those forward for up to 5 years. You have the child, they allow taxpayers to claim a tax credit. So we already have talked about what is a qualifying child and what is a qualifying dependent. We've already looked at how to determine that. So now let's talk about what that credit is. So the child tax credit, you get $500 per dependent. Now, we do have phase outs on the child tax credit. So as your adjusted gross income exceeds 400,000 for married or 200,000 for all other, and the child tax credit is parted to 1,400. So the dependent child tax credit is also subject to a phase out. You also have credit for child independent care expenses. All right, so this is for working taxpayers who must pay for child care services to work outside the home. The credit is a specified percentage of expenses incurred. Credit percentage varies based on the taxpayer's adjusted gross income, and they are capped at a maximum of $6,000. You also have education tax credit. Qualified low and middle income tax individuals defray the cost of higher education. So the credits are available for qualifying tuition and related expenses incurred by students pursuing undergraduate or graduate degrees. So I believe the maximum credit for the American Opportunity Credit permits a maximum of $2,500 per year for the first 4 years of post-secondary education. And the lifetime learning credit expenses, which is up to $2,000 per year, incurred in the year in which the American Opportunity Credit is not claimed. Use one or the other. You also have the earned to the working poor. So in addition, the credit helps to offset the costs of other federal taxes, such as the gas tax. The credit encourages and rewards work. So as discussed below, a taxpayer's earned income tax credit increases as earnings increase until reaching a maximum. This creates an incentive for people to seek employment or to increase their work hours. Premium tax credits. So individuals and families whose household incomes are at least 100% may be eligible to receive premium tax credit if they purchase insurance via health insurance marketplace. So the Affordable Care Act was enacted to reduce the number of uninsured individuals in the United States by expanding public and private insurance coverage. Included in the Affordable Care Act is one of them. So individuals can choose to receive the premium tax credit in advance. The marketplace will send the money directly to the insurer to reduce the monthly of insurance payments. So this was a tax credit created to promote the Affordable Care Act. Chapter 10, which we covered gross income exclusions, deductions, and credits. 11.